Starting a small business can be an exciting and rewarding experience. While there are many aspects that go into forming a business, from choosing a name to selecting vendors to filling out all the proper paperwork, one of the most important areas to focus on is the financial steps you'll need to take when beginning your business. Your financial foundation can sometimes be the difference between a new business succeeding or failing. So it is so important to make sure that this foundation is strong. Here are 6 financial steps that all new small business owners should take when preparing for opening of their business. Step number 1, calculate all of the startup costs. Startup costs are one of the biggest expenses you'll incur in the development of your business, and these expenses occur typically before you've even sold your product or service. For example, brick and mortar locations have a significantly higher startup cost than e-commerce stores, and businesses that require a lot of licenses and certifications can be costly to get off the ground as well. There are a number of expenses that can go into startup costs, and here are just a few of them. Rent, a mortgage down payment, salaries, website development, advertising, permits, accounting and legal fees, and business filing fees. Step number 2, determine your required living expenses. Since a lot of your time and resources will go into building and growing the business with the possibility of not seeing a profit for a while, it's so important for those looking to start a small business to be able to have enough to set aside for their basic living expenses to get them through the time period before they start making a profit. If you're leaving a job to start your new business, you'll also need to take into consideration the cost for healthcare and other benefits that you'll need to have, which no longer will be covered by an employer. A good rule of thumb is to have at least 6 months of living expenses saved before starting. And step number 3, get your credit in order. While you will be able to borrow money under the business name when you're just starting out, that initial funding with loans and credit cards will be based on your personal credit. Even after being established for a time, many banks will still consider the owner's credit as a deciding factor on the ability to lend, as well as the interest rate. You'll want to take stock of your assets, such as the equity in your home, as well as find ways to increase your credit score as high as you can. And if you're already carrying credit card debt, it's so important to pay down as much as you can before considering taking on other debt. And remember, the more debt that you have, it can significantly affect your credit score because of that credit utilization. And step number 4, determine your tax burden. An important and unavoidable expense in business is taxes. And unfortunately, many entrepreneurs starting a small business may forget to take tax burden into calculation when determining if their business has the potential to be profitable. You will need to consider such issues as self-employment tax, federal, state, local, and payroll taxes. These issues all need to be taken into consideration when determining how to classify your business, as well as your ability to hire employees and the amount they can be paid. Step number 5, assess your profit potential. It is so easy to get wrapped up in the excitement of a good idea, but it's important to make sure that you fully assess the potential of your business before embarking on it. Not all ideas can form a business, and it's essential to assess your income and sales projections to make sure that once your business does start making money, that it's designed to be able to have the income cover the basic expenses. You can determine this potential by performing your own market research, identifying possible customers, as well as current industry competition, so you can see how much it will cost for you to be able to compete with them. And last, step number 6, determine funding methods. You will need to determine what methods of funding you will use, not only to start your business, but also to keep it going and to help it grow. Some of the most common sources of funding include personal savings, loans from family and friends, small business loans, and outside investors. You should carefully consider which method can help your company continue to grow and how much it's going to cost in terms of interest or equity. Help yourself get a solid financial start when creating your small business by utilizing these steps. Making a plan in every aspect of your business is one of the best ways to set yourself up on a path towards success.